Holy smokes everyone, some huge news has just come out and it looks like this debt bubble is going to turn into a credit crunch or a credit freeze. Wells Fargo has just announced it's going to be suspending, closing all of people's personal lines of credit, and this is leading many people to think, why is this happening? Why are they doing this right now? Well, I'll tell you why. Because there's something huge, there is something brewing underneath the surface. There is a crisis that not many people know about, except for people that have been following this channel and other financial channels. There is a crisis just around the corner that is about to come. Many people have thought that we're fully recovered, that the economy is booming, that we've made it out of the 2020 recession in the US and the global recession that we entered. But really what you have to know is we've been in a fake recovery and the real storm is just about to hit. But this time, all the governments, not just the US, around the world, they've maxed out the credit, so they're not going to be there to save you this time. So in this video, I'm going to dig a bit deeper. We're going to go into this article and this information about Wells Fargo shutting down their lines of credits. I'm going to go into why they're doing this, the banking crisis that is coming, and then I'll go over how we can prepare. Okay, everyone, let's not waste any time. Let's get straight into it. So look at this, everyone. Wells Fargo tells customers it's shuttering all personal lines of credit. The bank is shutting down all existing personal lines of credit in coming weeks and no longer offers a product, according to customer letters reviewed by CNBC. Is this because Wells Fargo foresees a wave of defaults and bankruptcies coming? We'll get into that in just a moment. The product, which typically gave users $3,000 to $100,000 in revolving credit lines, was pitched as a way to consolidate higher interest credit card debt, pay for home renovations, or avoid overdraft fees on linked checking accounts. With its latest move, Wells Fargo's warned customers that the account closures may have an impact on your credit score, according to a frequently asked questions segment on the letter. So just to add insult to injury and kick people while they're down, they're not only saying we're going to close your account, but it's also most likely going to affect your credit score. And this is also coming at a time where many Americans are finding it very hard to get credit, and also people with good credit scores are finding it hard to get a mortgage. Because look at this article, everyone. Wall Street giants want to be a landlord. Data shows mega banks are buying up US real estate. And not just this, denied many Americans have been turned down credit for 2020, and also it's still happening in 2021. So why are the banks doing this? Well, because like I said, Wall Street wants to be your landlord. They want your homes. They're coming for your home. And this could just be a way for the banks to get it a bit quicker and a bit easier. And we all know the Great Reset, one of their agendas is you'll own nothing and be happy. Well, how will they do this? People aren't just going to give up their homes. The way the banks are going to have to get their homes is foreclose on people or get people all hooked on debt and then shut it off, bam, close it off, and then all of a sudden people have no way to pay their bills, and then they default, and then the banks swoop in and take their homes or sell it to their mates on Wall Street. So listen to this, everyone. Another part of the frequently asked questions asserted that account closures couldn't be reviewed or reversed. We apologize for the inconvenience and the line of credit closures will cause. The bank said the account closure is final. So they're saying, sorry, we're not sorry, we're closing accounts anyways. So it says here, customers have been given a 60-day notice that their accounts will be shuttered and remaining balances will require regular minimum payments at a fixed rate. This is according to the statement. When it was offered, the credit lines had a variable interest rate ranging from 9.5 to 21%, so still a pretty steep rate. The move is a strange one, given the banking industry needs to boost loan growth. After a burst of commercial lending during the early days of the pandemic, loan growth has been hard to muster. Corporations have used money raised in stock and debt issuance to retire bank credit lines, and consumers stuck at home had fewer reason to use credit cards. So that's right, it is a strange move, but what's happening, like it says here, businesses, even though there's low interest rates, they're not taking on huge amounts of credit from the banks right now. And also, most people aren't taking on loads of credit right now. Why do you think they're doing that, people? It's because most businesses and most people know that we aren't out of the woods yet. And unfortunately, this economy relies on people taking on more and more debt. It doesn't really rely on innovation or people using their own cash now. They're always pulling forward demand from the future. And what that means is it can mean things are really good right now, but that means the future growth is going to be smaller and smaller. And what we've done during 2020, during this pandemic, we've pulled forward years and years of demand forward to bail us out right now. But all that means is the problems in the future next year are just going to be much worse. And just to make it a bit more personal to see how this is really affecting people, let's read Tim's story. So one customer said the change is prompting him to switch banks after more than a decade with Wells Fargo. Tim Tomasi, a Portland, Oregon programmer, said he used a personal line of credit linked to his checking account to avoid expensive overdraft fees. It's a bit upsetting, Tomasi said in a phone interview. They're a big bank and I'm a small person, and it feels like they're making decisions for their bottom line and not for customers. A lot of people are in my position and they need a cushion every once in a while from a line of credit. So unfortunately, right now, many people are in Tim's situation. But what it's time to do, people, it's time to go back to old-fashioned times. Start paying off high interest debt and create an emergency fund, because the government's been there to bail people out during 2020, but they've pretty much maxed out the debt. You know, there's a negotiation about to happen about the so-called debt ceiling, which we all know there's no real ceiling because they keep raising the roof. But what's happening is the government's getting, very, very close to kind of maxing out its debt just for this year, or they're finding it very, very hard to service the debt. So they're not going to be able to, just announce another $5 trillion stimulus to bail out all these people that are going to go into these defaults and bankruptcies next year. But people, let me connect the dots, because this is just the tip of the iceberg on what's really happening. You have to know the broader picture, what's really happening, and I'm going to bring it home, bring it all together to tell you what's really going on in the banking sector, in the economy, and in the markets. Look at this, everyone. JP Morgan says it's also hoarding cash for the crash, like I've done a previous video on. JP Morgan says, if you look at our balance sheet, we have $500 billion in cash, and we've actively been effectively stockpiling more and more cash, waiting for opportunities to invest at higher rates. Diamond said, I do expect to see higher rates and more inflation, and we're prepared for that. So what is it that JP Morgan sees? Well, they're saying they see a crash coming, and so they're stockpiling cash. And what also do we see happening? We're seeing a flight to safety. People aren't piling into the stock market like they were doing before. They're piling into bonds and they're piling into cash. But something I've also been warning about, and something many other YouTubers or financial analysts have been talking about, is the reverse repo market and the signals it's sending to the markets. Now, many people are saying, the reverse repo market is just a technical thing. It's nothing to see here. Don't look here, look over there. Well, we do see there is a reason why the reverse repo market is booming. It sounds really complicated, but all it is banks, they park money at the Federal Reserve, they exchange their cash for US Treasuries because, again, they want a flight to safety, they've got too much money, and what the Federal Reserve did is they lifted the interest they pay to the banks, but not you. So yes, they have lifted interest rates, but only for the banks, not for the average Joes or the retirees or the savers. Because look at this, everyone. This is the Federal Reserve reverse repo markets. And as we can see here, it is absolutely skyrocketed. And it is now at roughly $1 trillion a day. That's right. Not 1 month, not a quarter, a day. That means banks and other foreign central banks are parking up to $1 trillion every day at the Federal Reserve. And as you can see here, normally, there's a spike at the end of a quarter. But this is really triple what this market operation is normally. And why I think they're doing this is because, like I said, they do see a crash coming. They may, plan or engineer a crash, because what you have to know is over the past 100 years, they've been engineering these boom bust cycles. They create a boom, get everyone hooked on credit, and then they crash the markets. And every time they do that, they gain more and more of the wealth. Okay, everyone. So what this means for you and me, this means though we've had good times right now, it seems like the markets are booming right now. The Federal Reserve tells you the economy is strong everything's fine, there's nothing to worry about. Really, this has been a fake recovery. This has been a fake boom because they've given out free money, the free stimulus checks, because they've increased the money supply by 30%. But now the stimulus is being taken away. M2 money supply growth is declining rapidly. It's roughly now at about 13% and it is still declining. They told us, don't worry, don't pay your rent for up to 2 years. Don't pay your mortgage for up to 2 years. Everything will be all right. We'll sort it out later. Well, now the music is starting to stop. The party is finishing and the punch bowl is being taken away. And now the banks and the government and everyone's going to have to face this big debt burden that's staring us right in the face. And unfortunately, if you shut down the whole economy for a year and a half and we're seeing more and more shutdowns, it's not over. The illness is not over. There will be consequences. And what I think this is going to lead to is this could lead to America and the global economy entering into a double dip recession, entering into recession again in 2022, and we could enter stagflation. That is where unemployment is high and inflation is high, and there's nothing the Federal Reserve can do about it. Or what it could happen is it could appear that we have deflation, but that's after prices will be sky high. And even if, the CPI, the official inflation data, goes at 0 or flat or 1%, well, prices will still be much higher than they were in 2020. So everyone, what can we do to prepare? Well, like I said, the government is not going to be able to come there and save you this time. So it is time to do whatever you can, get a second job, a part-time job, start a side hustle, start a YouTube channel like me, pay off high interest debt, and do the old-fashioned thing, build an emergency fund so you don't have to rely on the government to save you, or you don't have to rely on a credit card and getting into more and more debt to get out of a tough situation. Also, what this means, in case we do enter in some kind of crazy banking crisis, you don't want to have all your money in cash at one bank. You want to diversify. Again, it's not financial advice, just my opinion and my thoughts. You don't want to have all your cash at one bank, and you also don't want to have all your money in one asset class. But everyone, what do you think the banks are planning, and what do you think is going to be coming in the markets and in the economy in 2022? You let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you up to date on the latest that's happening in the markets. And of course, if you're bored, I'll put up some of my other videos here. I'll see you all there.